Welcome back to MyFinJourney. Today's guest is August Biniaz, Chief Investment Officer and co-founder of CPI Capital, a real estate investment firm focused on acquiring and operating U.S. multifamily value-add real estate and build-to-rent communities. Over the course of his career, August has helped close more than $225 million in multifamily acquisitions, working both with retail and institutional capital while building relationships with family offices, funds of funds, and sophisticated investors. If any of that sounds like words you've never heard, this might be a good episode to listen to learn what you don't know, and to ideally help you on your financial journey. What makes August particularly interesting is that he has lived multiple sides of the real estate world. He started as a real estate agent, built custom homes through his own development company, and eventually transitioned into syndications, asset management, institutional capital raising, and fund management. He is also the host of Real Estate Investing Demystified, where he focuses on helping investors understand the reality of building wealth through real estate. For the MyFinJourney audience, this episode is about scaling from small deals to institutional thinking, understanding capital allocation, and what separates professional investors from everyone else. August, welcome to MyFinJourney.
Thanks for having me. Looking forward to this.
Definitely, August. It's our pleasure. So, August, I wanted to really understand, where did you start? How did you catch the real estate bug?
Yeah, when I respond to that answer, I always say I come from somewhat of a real estate family. My maternal grandfather was a real estate broker. He owned his own brokerage firm, and my mom always, invested in real estate. She was a stay-at-home mom, but she always invested in real estate. And so, if real estate was a language, I spoke it from an early age. I understood the real estate world, and so it was just a natural move for me to get involved in real estate. So that's exactly what I did in my early 20s. I got my real estate license. And when I looked at my other peers and what have you, I didn't really see myself being a real estate broker long term, but I really enjoyed active aspects of real estate. So started doing small fix and flips early on, started my own general contracting company. Start building actual ground up development homes, so both spec and custom homes. And eventually had the opportunity to partner with a couple of great partners and start CPI, which the mandate initially was to allow Canadian investors to have exposure to U.S. multifamily, one of the best performing asset classes under the commercial real estate umbrella. But since then, we've opened the door for U.S. investors as well, and we're also have built to rent in our vertical as well.
That's awesome, August. So help us understand, when you were growing up, when you were looking at your mom buying these homes, etc., what was her investment strategy? And was that the same investment strategy, you started out with before you went into building spec houses?
I mean, her view of it was a lot different, but it's really a fundamental view of real estate, which is tangible. And my mom always said, if your business plan doesn't work out, you can always move into it. It's not a situation where, you're investing in equities or in venture capital or in an idea. You're investing into a structure, so you can move into it. So that's the way I looked at real estate early on. I grew up in Iran, and over the past half a century, Iran has gone through hyperinflation, and there isn't a lot of options for Iranians as far as investment, if it's public equities or bonds or what have you. So real estate is that common denominator for Iranians to invest in. So even if you can't afford real estate in urban areas, people buy a piece of land in the village somewhere that is affordable. So Iranians are they're somewhat financial savvy type of people, but they also are very lovers of real estate, and they invest in real estate. Usually these empires that have shrunk down to the modern day countries today, they do love land, because that's what they did. They conquered land for a long time. Well, that's my own view of it. But yeah, so I mean, to circle back to your question as far as my mom's strategy. So fundamentally, yes, real estate is tangible, and it serves a need that exists for people trying to, for the consumer, for having a roof over their head. But it gets more complicated as soon as you bring in different business models that exist, and bringing in the fact of raising capital from investors and so on, and syndicating deals, which makes it more complex, but it's still serving a basic human need that exists, which is shelter.
It's a very powerful response, August. Help us understand, from your perspective, is there one right way to invest in real estate?
Yeah, I mean, going back to the old adage, don't lose money, right? So real estate is, you can maximize your returns in real estate as soon as you use debt. Going back to the country of Iran or more developing countries, a lot of times there isn't debt available the way it is available to more Western, more developed countries. Even if you compare in the North American continent, Canada and the US, debt is abundant, but in Mexico is much difficult to get debt for real estate. So because in North America, particularly Canada and the US, we've got used to using debt, it also creates potential distress or potential risk associated with real estate. So to answer your question, as long as you are putting the right type of debt on your deal, you should be in a good position for real estate, because real estate has beaten inflation historically. It grows faster at a faster pace than inflation does, so it's a great hedge against inflation. But real estate also comes with other risks aside from debt. Is also you're investing in a structure, so that structure could have issues if it's to do with plumbing, structural issues, electrical, other concerns. You could have issues with regulation when it comes to municipalities, cities, state or federal regulations could come in. Simple one that I could use in today's date is short-term rental. There's new regulation coming in and making that business much more difficult for people, for investors. So yeah, real estate is a great way of building wealth. There's a common thing that goes around social media. 90% of millionaires have made their money in real estate. That's true. Look at the baby boomer generation, right? Majority of their wealth is in real estate. Real estate they bought for really cheap decades ago, and that real estate is worth millions of dollars. And a lot of times they don't have any debt on there, so that's their nest egg. That's that $80 trillion that they're going to be passing down to the next generation. But yeah, lessons learned. Probably the simplest one is you always have to be cautious on what type of debt you're putting on your deal, because that is the Achilles heel of real estate, is the debt.
You talked about inflation. You talked about the value proposition of that baby boomer who bought, let's say, 30 years ago, and how much equity they're sitting on, potentially trapped equity, but equity nonetheless. You touched on the idea that Canada and the US have more favorable debt options than maybe Iran and Mexico. But when we look at the US and Canada, it does feel like the way they look at multifamily real estate, or the way they even look at single family real estate, is very different from a debt perspective, in terms of the different products available. So I'm curious, given your expertise, why do you think it makes sense for Canadian investors to invest in US real estate?
Yeah, on a high level, distinguishing the differences between the debt environment in Canada and the US. The first thing is on the residential side. When it comes to primary resident or single family, the US has longer term mortgages. So the conventional mortgage in the US is a 30-year mortgage, which is the term is actually 30 years. So if you can lock in your mortgage rate at a good amount, some people have locked in it at sub 3%, sub 4%, just barely above inflation. So the price you're paying for that debt compared to where inflation is, you have to pay the bank much less than what you've borrowed. But the term is 30 years, so you're not concerned about where mortgage rates are going to be in a few years. Whereas in Canada, mortgage terms are around 5 years. So the most common one is 5-year mortgage term. So that every 5 years, you have to go back to your financial institution and you have to renegotiate and get new mortgage interest rates, and that could fluctuate depending on where the economy is and where the real estate market is. So that's one major difference. The other difference on the commercial real estate side, multifamily is an asset class we're very familiar with and we invest in. So the type of lenders that exist in Canada and the US are somewhat different. We do have agency in Canada as well. In the US, you have Fannie Mae, Freddie Mac. In Canada, you have CMHC. And CMHC is the government entity that lends capital for commercial real estate deals in Canada. But you don't have as large of a pool as lenders in Canada as you do in the US. In the US, you have insurance companies, large funds that lend in the commercial real estate multifamily space. But in Canada, your pool of lenders is much smaller. And then the other difference I would say overall, as far as differences between real estate, not just debt, is also volume, right? US, much bigger population than Canada, much bigger economy than Canada. The number of deal transactions are much less in Canada than they are in the US. So on the multifamily side, for example, you have much more higher velocity and higher number of transactions than there are here in Canada, where if an investment firm buys a multifamily deal, they usually hold it long term rather than trying to recycle and move deals. So those are some high level nuances between the two countries as far as debt and the real estate landscape. Yeah, you also have like these two major cities in Canada, which is Vancouver and Toronto. Vancouver being in the West Coast, where I'm currently located in, and Toronto on the East Coast, somewhat similar to your Los Angeles and New York. But that's where the majority of the people want to be living, where they want to be. And if you look at another aspect in real estate, I think is important to touch on is cap rates. Cap rate is a great metric to assess real estate and the yield that a real estate deal provides. Cap rates on an apples to apples comparison are higher in the US than they are in Canada. So you're getting more of a yield on the exact same vintage, same property type in the US than you would in Canada. It makes a lot of sense for Canadian firms and individuals to want to invest in the US because they're getting higher yield on their capital than they would here in Canada.
That makes sense, August. And I'm curious to understand from your perspective as a Canadian, as a potentially Iranian Canadian, do you feel like most people in Canada think of investing in real estate as buying their single family home? Or do they think of it as investing in a single family home that's generating rent, or investing in multifamily that's generating rent? How do they look at, investing when you look at the question from a financial literacy perspective?
Yeah, I mean that is that this idea of investing has changed through different generations. When you're comparing the median income compared to median price home in more urban areas in Canada, it is becoming much more burdensome for people to be able to own their own primary residence, let alone to become investors in real estate or in single family. For example, Vancouver, your median income is around 90,000 and median price home is $1.7 million. That is burdensome for somebody to be able to own their primary residence, let alone try to go on and invest. If you compare the same thing historically, that gap was much less. Somebody could have an income of 30,000 and a home was around 50,000. So they weren't as burdened as their kids or grandkids these days. But overall, investing in real estate on the single family side is the best way to start. And the most common way of investing in real estate, owning your own home and then investing in another piece of real estate for the rental income, the appreciation it has. That's really what I would recommend. One of the common questions we ask our investors that come into our funnel, into our database, when our investor relations teams gets on a call with them, is always asking them if they own their primary resident. Because a lot of times, a lot of real estate gurus advise that you should just rent and you shouldn't own. I'm not from that school of thought. I think, especially if you want to get into the world of investing, you should really own your primary resident. Now, as far as debt, people have different views. I think you should definitely use debt, especially in the US, since it's a 30-year term, but so that capital can go somewhere else and work for you instead of being locked up in your home. But yeah, different viewpoint about this topic of investing in a home or what have you. I mean, another common question is your primary resident an investment? And a lot of gurus, again, say that's not an investment, that's your home. Well, I disagree, because when you look at the net worth of the baby boomers and the trillions of dollars that they're worth, majority of that is in their primary residence. So if that's not investing, that's their home. That 80 to 100 trillion dollars, what is that? Just their home? No, that's essentially an investment.
No, August, I think it's an interesting perspective. I'm probably in the opposite camp than you on that one. I view it as like, trapped equity, unless they're taking out a HELOC, etc. To me, at least. But
No, I
August, I want to
agree with that
circle
point.
back.
I
Mhm.
totally agree that people should use debt and use their equity in their home 100%. But this idea of not buying a home and just staying renters, or that their primary resident is not an investment, I don't agree with those two ideas.
Let's dive in deeper a little bit, if you don't mind, August. Right, like today we talked about Vancouver. We talked about how expensive real estate is in Vancouver. If you were that 25-year-old who's making, let's say, 200K plus Canadian dollars, well above the median average income in Canada, but maybe not enough to comfortably afford that $1.7 million house to buy a mortgage, to buy a 5-year term, etc. But you can rent that house, and that house feels like the natural progression, etc. Do you feel like there is an avenue or there's a thought process that says, hey, like rent right now until you can buy strategically? Is ultimately for you, is it black and white, or is there a lot of nuance in these types of decisions?
I think there is a lot of nuance. I mean, there's lots of options. If the medium home price in city of Vancouver is 1.7, you can move to the suburbs and get a home for a million, just over a million. If you're single, go out there and get married and bring in your spouse's income with you to be able to purchase a home. So yeah, the goal should definitely be initially to purchase a home. Are there times where it makes sense to wait and rent? I think, yeah, absolutely. Currently in the US, relatively speaking, interest rates are high, especially compared to a few years ago where you could get a 30-year mortgage at sub 4%. Today, the same mortgage is around 6.5%. So it doesn't make sense to rent for a couple of years to see where mortgage rates are at, especially if you're locking it in for 30 years. Absolutely. In Canada, because the terms are much shorter and home prices compared to the income are much higher, I think it's a big and important hurdle to overcome. So buying a home should be at the forefront. And for example, if you look at homes in Vancouver from 1995 to 2015, home prices in Vancouver went up 500%. So people who've invested in that time made a fortune. Right. So now the Vancouver real estate market is going through a buzz cycle. Prices have corrected both in the condo space, but in the single family space as well, all through the Metro Vancouver area. So I think it's a great time to enter the housing, to purchase a primary resident. But yeah, I mean, people have to be cognizant of that. Is it the right time to rent or right time to own? So I would say in the Canadian case, it's less of an advice to rent, more an advice to buy as soon as you can. In the US is not the case. I think there are times where you should sit on the sideline and rent instead of buying.
Very interesting, August. I do believe Vancouver is either at the top or towards the top of the most expensive, real estate to buy in the world in terms of like how much it's appreciated over the past, 2 decades. Concurrently, I think the GTA, the Greater Toronto Area, about 70% or so of people who move to Canada do move to the GTA. So in one area, you have very expensive house prices that have just gone up a lot in Vancouver, and you have a lot of population growth in the GTA. But despite those, let's say, data points, it sounds like you do prefer to invest in the US. So help the listener understand why you feel like the US is the better opportunity, and maybe where specifically in the US is the best opportunity to invest in your opinion.
I think our discussion a moment ago was on single family and
Yeah.
on that exercise that you use somebody younger who's just going into the household formation stage of their life. But when you're talking about myself or CPI, our investment firm, and as far as our mandate to invest in U.S. real estate, yeah, as far as the yield that are available in the U.S., as far as the friendliness of the government, as far as the taxes, as far as business friendliness, where there's no rent control laws in the states that we invest in. We're very focused on Texas and Florida. Each of those states alone have a larger economy than the whole country of Canada. Their population is, not that much less than the whole Canadian population. Canada's population is around 42 million people. So both of those states have almost more than half the population of the whole country of Canada. So yeah, I mean, the drive for us to invest in the U.S. is the return that we can achieve for our investors and the continued population growth, job growth, economic growth that exists in the U.S. And the other factor is some of the numbers that we look at is over 1/3 of the American population rent. Approximately 10% of the U.S. population lives in some sort of an apartment community. Now, townhomes and BTR falls under that as well. But we're talking about close to 40 million Americans that live in apartment communities, that style. So it's an area that has continuously grown, a demographic that has continuously grown since World War II. So that is what we're banking on, is the fact of that the U.S. is becoming more and more of a renter's nation, that because of affordability concerns or other issues or convenience, a lot of people rent, and that's the market we want to be in, which is the rental market in these more growing cities such as Tampa Bay in Florida and San Antonio and DFW in Texas that are forecasted to have huge population growth over the next couple of decades.
Thank you for that, August. August, I want to circle back and really drive deeper into the understanding of CPI, your understanding into why the Canadian investor should be investing in real estate, what the US investor can learn from CPI's investment strategy, and how it works.
Yeah, Canadian investors who get in touch with our firm and are looking to invest, they are savvy. They understand that there are more yield and returns available in U.S. real estate than their Canadian counterpart. They understand that there are strict rent control laws across Canada that makes it difficult for multifamily value-add investors to scale in the multifamily space. International investors, including larger institutions, including different countries, the Canadian Pension Fund didn't partner with a Canadian multifamily investor. So the advice to U.S. investors is that you have this great economy, you have the largest economy in the world, and you have the highest rent to value ratios in the world compared to any other country as far as our research. So it's a great opportunity to invest in your own backyard and reap the benefits. Every time we have a deal under contract, we create a single purpose vehicle, SPV, which is usually a limited partnership on the US level. And that's the entity that owns the property. And then our Canadian investors invest in a Canadian entity, which then invests into that US vehicle. LLCs are not tax efficient when it comes to Canadian investors, which creates double taxation. The other aspect of it is also compliance. So when we're raising capital from both Canadian and US investors, we have to deal with the regulatory side of things as well when it comes to securities compliance. So we have to adhere to SEC regulation, but also the Canadian provincial securities regulation as well. When we started CPI 6 years ago, we really copied the model of another Canadian firm that was investing in Phoenix. And using their model, they were forcing their Canadian investors to file US taxes and deal with the IRS on an annual basis. So when you deal with the IRS and you have to file US taxes, you have to hire a US accountant or a Canadian accountant that's licensed in the US, and it costs you between $1,000 and $1,200 on an annual basis. Actually, I've seen it as low as $600. So between $600 and $1,200 a year, you have to spend on your U.S. tax filings as a limited partner who's invested in a syndication on the U.S. level. Well, over the years, if it's a five-year project, that becomes erosive to your returns. But we noticed that this other firm, so we were like, hey, what's good for the goose is good for the gander. And we're going to copy the same model because this group has done billions of dollars in transactions. But early on, we had a lot of response from our feedback from our investors saying that, hey, I'm already dealing with a CRA. I don't want to have to deal with the IRS as well. So we went back to the drawing board and meetings with we ended up hiring a tax lawyer who was an expert in the space. And the structure we created relieved the Canadian investor from having to file U.S. taxes or deal with the IRS. Our partnership was going to be filing on taxes on their behalf. So that was a huge winning point because we could then, in conversations with those investors who would either be coming to us from these other firms who are already in existence or a newer investor, we would tell them that, hey, listen, our partnership will file on taxes on your behalf. So you don't even have to deal with the IRS or the U.S. So it was very beneficial to our firm. But yeah, that's basically some high-level stuff between Canada and the U.S. and the nuances and the tax regulatory framework.
I love it. Maybe, August, if you could also elaborate on how Canadian investors can use their retirement accounts to invest in real estate.
Yeah, great question. So over the years, when we did, our investor relations team had discussions with investors, a common question that would come up is, can I use my registered funds? As their retirement accounts, they're known as registered funds here in Canada. So similar to 401ks and IRAs. So in Canada, you can put a portion of your income towards your retirement through these different financial instruments that exist. And you have an option to self-direct those funds. The only major difference is that yes, you can have obviously the retirement accounts. Yes, you can self-direct into an alternative like a CPI capital investment. The only difference between Canada and the US is that Canada puts a restriction on what vehicle the deal is structured in. So if you're a firm like CPI and you structure your deals in a limited partnership, or if you structure your deals in a corporation, for example, in Canada, we don't even have LLCs. So I won't even use that example of LLCs. That is a structure that's not qualified on their the Canadian tax law to be used to be able to self-direct your investment into. One of the vehicles you can utilize is a complex structure called a mutual fund trust, and it's very cumbersome, costly, and laborious to put that structure together and launch that structure. But we really want to have this advantage and set ourselves apart from other investment firms and make the life a lot easier for our investors to use their retirement accounts and invest in our deals, because the yield they're getting in their retirement accounts is really nominal and they could get much higher returns investing with us. So it took us 2 years to eventually launch a mutual fund trust, which allows us to raise capital from Canadians who want to use their retirement accounts and invest. Canadians have close to $2 trillion invested in their retirement accounts, and now they can self-direct that and invest in a CPI Capital syndicated deal without a tax event. So the funds come from their retirement account, and they from their financial institution retirement account. The funds go into a custodian's account, and then from the custodian's account comes into our investment. And when the investment is divested, those funds go back from our account back to the custodian's account and back to the investor institution where those registered funds are held. So it never touches the investor's bank account, hence never triggers a tax event. So any profits they're making through CPI are basically tax-free or tax-deferred.
Makes sense, August. When you're looking at and when you're setting these up, do the real estate investments themselves have leverage? And does that impact the Canadian investors' ability to use their retirement accounts? Because in the US, if done, typically there are some UBIT or unrelated business income taxes associated with leverage in real estate transactions. So I'm wondering if Canadian law has anything similar that makes it a bit more challenging for Canadian investors to use their retirement accounts.
Yeah, no restrictions as far as debt. So if we are utilizing debt, be it agency or private debt on the U.S. level, bank debt, that doesn't restrict Canadian investors to participate in the U.S. deal just because there is debt on the deal. Now, as far as if there's debt being used, will they get taxed differently? Not that I know of. There might be an area I don't have expertise in. But for example, I know that on similar to the US, for Canadian investors, if a deal is a development deal, a ground up development deal, the profits are taxed as ordinary income. Whereas if the deal is a value add deal, the profits are taxed as capital gains. So you are taxed at a lower tax consequence depending on what deal you're investing in. So investors should be cognizant of that. For example, with CPI, we do both multifamily existing properties where we renovate and basically fix and flip, and any profits the investors make are tax capital gains. But on our development BTR deals, any profits that are made are taxed at ordinary income, which is a higher tax bracket. Now, it's important to note that our BTR deals yield a much higher economics and returns than value add deals. But even if you take into account the higher tax amount, you're still making a lot more on your development BTR deals than you do on multifamily. But because there's more risk associated with BTR than there is on multifamily value add deals.
And August, when you're talking about this tax, are you saying when they withdraw the money from their retirement vehicle or when their retirement vehicle actually realized the profit?
Yeah, so because the partnership files taxes on behalf of the investors, the net amount that goes back to the investors goes directly back into the registered account without a tax event. So yeah, there is no tax being levied against them just because they pulled the money out of their registered account and invest in a deal. But there is got to be taxes paid on the property level entity that has made these profits. So they will receive the net proceeds, and there is no tax event on those net proceeds that are coming back to the investor's registered account or retirement account.
Because it's set up as an LP. Versus an LLC.
Because that's a different item. So if you set up a deal in an LLC, it automatically, any taxes that you're paying, CRA is not recognizing that, be it through a registered fund or a cash investment. That triggers that concern no matter what. So yeah, that is the same when you're talking about a cash investment or a registered fund investment. But on the registered fund side, the reason you're not being taxed for using your registered funds and investing into an alternative and then taking those funds back is because you're never receiving and realizing those profits. The money never hit your bank account. Your money is coming from your registered fund institution to a custodian's account to the deal. It stays in the deal until the deal has been divested and those profits are made, and then it comes back again from the deal level entity to the net proceeds after paying your US level taxes. Then those net proceeds are coming back to the custodian and then going back to the registered account as well. So there's a bit of a complexity there, but yeah, the double taxation is a different type of tax that we discussed, and then the income tax is a bit different as well. The capital gains or ordinary income.
Understood. So August, pivoting a little bit, transitioning a little bit away from taxes back to real estate strategy, structuring. Help us understand. You mentioned that you're investing in Texas. You mentioned San Antonio. You mentioned DFW. I don't know the San Antonio market that well. With DFW, it feels like there is a general concern about, high vacancy, overbuilding. Talk to me in terms of what you're seeing in the DFW market or Texas in general, and your thoughts on that market.
Yeah, both San Antonio and DFW have some headwinds against them in those two markets, and that's as a result of oversupply. So post-COVID, when the central banks reduce interest rates and the Fed's funds rate, particularly in the U.S., a lot of developers building in these growth markets such as DFW and San Antonio went out there and borrowed a lot of money and started building a lot of product. That product came online and created oversupply, which has a direct effect to rents and occupancy. So yes, both of those markets are foreseeing that. But another number that we follow, another metric that we follow is new starts, construction starts. And if you look at the graph of construction starts in 2025, they've literally fallen off a cliff. So there isn't been a lot of deals that are being put together for construction and development. And exactly because developers are seeing that the markets are dealing with oversupply and rent compression and cap rate expansion. So they're just not building any deals. So we can see that there is a bottleneck when it comes to deals coming online, and that's what we're betting on. Secondly, there's also been a correction in both of those markets. So real estate prices on the multifamily side have dropped between 20 and 30%. That's not only because of rent compression and oversupply, but it's also because of cap rate expansion, which is something that's really out of the control of investors. That is basically the way that a multifamily is, or commercial real estate is assessed is through the cap rate approach of the prevailing neighborhood cap rate. And what that is the yield that a property produces. And the prevailing cap rate tells you what is the price that your property is going to be purchased at relative to not comparables, but how the market is really performing. So when that cap rate expands, it really pushes down the property values. And both of those markets are currently dealing with those issues that I just mentioned. But we also know that both San Antonio and DFW are forecasted to have huge population growth. By 2050, DFW is looking to be at 15 million population. And San Antonio, you can also see that with so much public-private infrastructure going in, with a lot of these raised highways being built, the upgrades to the San Antonio airport, which is a $1.5 billion upgrade, and also the new stadium for the San Antonio Spurs, who are in the NBA Finals as we speak. You can tell that the research that the city and the municipality has done into the growth that is looking to be at these two huge major cities, it really excites groups like us to want to come in and invest. So yes, I would say short term, those cities are dealing with some headwinds, but long term, we're very bullish on San Antonio and DFW because of so many fundamental drivers that they have when it comes to population growth, when it comes to a lot of Fortune 500 companies moving there, when it comes to a lot of jobs, affordability as well. Both of those cities are affordable when you're talking about the rent burdenness of the tenants that exist there, and so on. So, yeah.
No, thank you. Thank you. Very, very informative. I guess the follow-up question would be why not Austin, which was once referred to as like the Silicon Valley of Texas, and why not Houston?
I think Austin, to answer that quickly, I think Austin is it's a double-edged sword. It's what it has going for it. The greatness of Austin is also it is its difficulties as well, because the market, it is such a great market. A lot of, just like you said, Silicon Valley of Texas. A lot of investment firms come in and build a lot of supply, and supply has downward effect on rents and occupancy that we just discussed. So Austin is reeling with that oversupply that's still there, and a lot of hype. Obviously, you had large investment, large companies moving there, like you had Tesla moving their headquarters, Elon Musk moving there. Even when it comes to the popular culture, you have Joe Rogan moving his podcast head studios to Austin. So Austin has a lot of great things going for it, but currently is definitely going through his buzz cycle. But I think Austin is also a great market to invest in. Currently is difficult to make deals pencil there, but I think it'll turn around and come back again. But now, as far as Houston is really, I don't want to use some of the, pejorative kind of insults for Houston, but it is a large city. It has somewhat of a boom and bust tendency to it, because it is energy related city when it comes to its dependencies on oil and gas. And then it's also your major coastal city in Texas, which is susceptible to hurricanes and other when it comes to potential natural disasters. So we try to stay away from Houston, and for now from Austin, but very bullish on San Antonio and DFW.
Understood. Understood. Transitioning to Florida, maybe for a couple minutes. What challenges have you seen there in the Tampa market? Has it been, insurance? Has it been something else? Help us kind of understand your read of that market.
Yeah, I mean, that's another coastal city for you. And when I talked about susceptibility to natural disasters and hurricanes, Florida comes to mind right away. We acquired an asset in June 2024, and soon after, major hurricane hit Tampa, which hadn't hit Tampa for close to a century. So our property got hit with that hurricane, and now it's been 2 years, and we're still going through the process with the insurance company. They've already provided us with close to $4 million in damages relief, but they still, in our opinion, owe us much more. So we're going through a process of lawsuit suing the insurance company. So yeah, when you're dealing with investors and having to send those monthly updates to your investors, letting them know that now you have to go through a lawsuit process, it definitely creates some anxiety for investors and our firm as well. But overall, we believe in the Tampa market, even though with the hurricanes that exist, insurance prices have gone up nationwide, but I would say in more coastal cities have gone up more than they have done in other areas, but we take that into consideration. So it's not just limited to our firm that insurance prices have gone up. That is a factor that every investment firm is looking to invest in Tampa or coastal regions has to underwrite with. So yeah, I mean, now having invested in San Antonio, DFW, and Tampa long term, as far as kind of my personal view, if I had to, it's really difficult to try to pick, because there is great opportunities in both markets. And this comes from an investor myself who is dealing with an insurance company now for 2 years and having to go through those headaches and lawsuits and what have you. But I'm still bullish on Tampa as well. I think if it's a right opportunity, you can put the right debt on it, have the right insurance on there. I think there is great opportunities to make money in all those cities, but you have to be cognizant of that the city does come with a caveat of potential hurricanes and storms. But as general partners, we have to make that make sense for our investors and explain that and provide that information so the investors can make the conscious decision of investing in a region that has potential for natural disasters.
No, it makes sense, August. August, I've been peppering you with questions, and I appreciate the diligence and thoughtfulness of your answers. As I hear your answers, as I reflect on your journey, I really want to understand, your mindset, because not many people accomplish what you've accomplished to date, going from being in real estate on the transaction side as an agent to transitioning to running your own construction company and building spec houses to transitioning to value add multifamily. Like, most people don't do ground up single family houses. Most people go to multifamily but don't necessarily do build to rent, ground up building communities. I really want to understand from your perspective why the transition is it worth it from your perspective, or would it have been better to just, focus on maybe luxury ground up houses
Yeah, I
in
mean,
Canada, I
if
assume?
it's no, yeah, it was in Canada, but I would answer that in a way. It really depends on the person, right? So I know a lot of people in the single family spec home development that have made a fortune in that space and have done tremendously well for themselves and their families, and they're happy where they are. I just didn't see that for myself. I was looking for an industry that I think Alex Hormozi, somebody who I watch occasionally, explained this idea about your skill set and the industry, the business that you're in. He was talking about having a 10 skill set in a two industry. So I would say that the real estate private equity space is definitely a 10 industry, and it's rare to be a 10 skill set individual in that space, because the 10 skill set individual is someone who is an Ivy League graduate who understands real estate, who's worked for a real estate investment firm or private equity firm for years, and now they're looking to go into a venture on their own. So those are very rare individuals. So most probably you have a much lower skill set than the industry of real estate private equity. So that's the way I looked at it. I felt that building homes was a lower industry. The way I was looking at it, the scalability wasn't there. The ceiling was easily reached, or somewhat easily reached. I felt like that private equity, and the more research I did in the world of private equity, I mean, Blackstone, the largest private equity firm in the world, started out as a classic private equity firm, buying companies, taking companies public, taking them off the stock market, doing leverage buyouts and so on. But at some point, they had a higher allocation to real estate than they did in private equity, buying companies. So they were buying more real estate than they were buying companies. Today, they have a larger allocation to private credit, but that's because of AI and what have you. But you can see Blackstone has over $1 trillion, well over $1 trillion of assets under management, and their growth since the late 80s has been astronomical. Same thing with lots of other private equity firms, KKRs, the Apollos of the world. They have huge allocations to real estate and they've done tremendously well. So that's what excited me. It was about the scalability. It was about not having a ceiling. It was about being able to achieve much more. It was also the fact that as a home builder, you're usually restricted. No, I'm not trying to be hard on home builders. Like I said, I love home building. At some point, I'll probably dabble in home building as well. I'm planning to build our family home in Florida soon. But so I love the space. I think as a man, you should definitely, one of the ways to become a fully, fully strong man is by building a home at some point. But there to, you're usually restricted to the area that you live in, or the area in one market that you're a home builder in. You rarely see home builders other than merchant builders that are building nationwide or even internationally. Whereas private equity firms, it's very common to invest internationally, or even sorry, it's very common to invest nationwide or even internationally. So that's another aspect that excited me. It's about the potential that existed in the world of private equity, comparing it to construction or single family world. So that's what made sense for me. That was where the dreams and the vision that I had for myself and my company and my partners. And that's kind of the reason I went that route of trying to build something to this magnitude.
I love your answer because there's a lot of wisdom behind it. But I do want to dive deeper if that's okay, August. You mentioned when you started as a real estate agent that you were kind of looking around and you knew that you didn't want to do this for the rest of your life. In your previous answer just now, you mentioned about home builders and maybe how your mentality was a bit different than theirs in terms of like scalability. The flip side for like at least a lot of home builders I speak to that do custom made homes, let's say you're, $2.5 million type houses, they're typically walking away, let's say, with maybe 700K in profit. And so the margin can feel very high on that one project, where in a shorter period of time, where in multifamily, it feels like the scale is what really gets you over time. So from your perspective, it feels like you were very clear on your vision and you knew your numbers and you knew maybe how life wanted to look for you. And that, like you mentioned, was different than maybe your peers. From your perspective, at all phases in life that you've gone through, because you've worked with many different people in many different aspects of real estate, why do you feel like your vision has been different than maybe your peers? Or, if you disagree with the central premise, that's also fine.
Yeah, I mean, there's two different ways of looking at the difference between home building or fix and flips and the profit margins that exist there, and then the profit margins that exist on more multifamily value add or the syndication or real estate private equity side of things. Anecdotally, when I looked around the space in here in Vancouver, where I was located in, it always took a few generations for that home builder to be at a level that they're now building either townhomes or high rises or low rises. It took a few generations. It was now the grandkids that were doing those projects. So the velocity of growth wasn't there. Whereas when I looked at the private equity space, multifamily value add, I saw firms, I saw a girl working for a telephone company and started a real estate private equity firm. And 10 years into it, she had done over $5 billion of transactions. So you'll never see the B world in custom home building. The B world is never there. Whereas in multifamily and private equity world, you are seeing the billions kind of world that exists. So that was one side. On the numbers as well, as soon as you bring in the GPLP component, where you're going out there and raising capital from investors, and you're being compensated as a general partner through fees and through carried interest or the promote, the profits are really unlimited as well for the GP, because in most cases GPs are not investing any capital in the deal. If they are, it's somewhat nominal, but the return they're getting on the capital they've invested is truly astronomical, right? Especially if you compare it. So let's say if you're doing a spec home development as the investor, you have to put up all that money. So you're putting in on a $2 million deal, you're putting in between $500,000 to $1 million of cash to then make that 500 or 700 on the back end. But as a general partner on buying a $10 million multifamily deal, you're probably bringing in $3 million of LP equity. Maybe at most you're putting in 300,000, which is 10% of the equity. But the profits you're making on the back end and through the fees are much higher. So the return you're making on the investment you're putting in is astronomically higher. It's also the scalability factor of it. You're other than merchant builders, you rarely see people building tens or hundreds of spec homes, because they could possibly shoot themselves in the foot as well, bringing too much supply to a certain market when you talk about spec homes. Whereas on the multifamily side, on the commercial real estate or private equity side, you're dealing with such a bigger market and such bigger deals that allows for scalability. So it's really it's an unfair fight between single family spec home building and multifamily value add on the institutional level.
I hear you, August. August, this has been a great conversation. I've loved the insight, like I mentioned earlier. If somebody's listening to this conversation and they wanted to learn more about you, learn more about your firm, what you guys offer, what's the best way for them to reach out to you?
Yeah, I'm very active on LinkedIn. August Biniaz on LinkedIn. I'm a LinkedIn top voice, so create a lot of great content about the economy and real estate on LinkedIn. Definitely send me a connection request. Love to book a call. The other platform is our website, cpicapital.com. A lot of great information on there. We have our underwriting model that you can log in and download. We have our webinar master classes that we hold on a monthly basis, bringing on experts and having discussions, only accessible through our website. And then you can also access our podcast right here on our website as well, which is on YouTube and 17 different podcast platforms. So a lot of great content and information on there.
Beautiful, August. Like I mentioned, it's been a very insightful conversation. I really loved it. I loved how you were able to go deep on a couple different topics and maybe add insight that, the average person might not be aware of, whether they're an international investor and how they can get invested and access to the US market. I loved how you elaborated more specifically on your firm and how it's pretty proactive in terms of identifying investor pain points and really building end-to-end solutions. Ultimately, for you, the listener, if you've listened to this and you've found a lot of value, please like, subscribe, and share this episode with a friend so that they can also learn and grow. And ultimately, you can help them improve their financial journey. Until next time, guys, speak soon. Bye.